This episode is brought to you by Indeed. When your computer breaks, you don't wait for it to magically start working again. You fix the problem. So why wait to hire the people your company desperately needs? Use Indeed's sponsored jobs to hire top talent fast. And even better, you only pay for results. There's no need to wait. Speed up your hiring with a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Reality radio for a really great future. We're talking real money.
Welcome once again to Talking Real Money Daily. I'm Don McDonald, back from my long sojourn up to New York City to see family, which kind of interfered with the production of the podcast. So a couple were missing, but I'm glad you're listening, and I hope you continue to do so. And spread the word and tell your friends, because this is talk about the real financial issues, the real investing that you need to understand, as opposed to the games and the gimmicks and the stupidity that inhabits much of the financial world, including the financial press, which of late has been trying to milk this whole concept of an inverted yield curve. Now, you're probably scratching your head going, what the heck is an inverted yield curve? Well, under normal circumstances, short-term bonds yield less than comparable long-term bonds, because the longer you hold a bond, the more return you require to be rewarded for that uncertainty that time brings. So a 30-year treasury tends to yield more than a 5-year treasury note. Now, sometimes those yields invert. Sometimes the longer-term securities, we're going to use treasuries in this example, longer-term treasuries yield less than the shorter-term treasuries. That's called an inverted yield curve. And it occurs when there is some concern about the short-term strength of the economy or potential short-term weakness in the economy. And when economies weaken, banks, federal banks, like the Federal Reserve, tend to loosen up credit, lowering interest rates. So people are betting on longer-term bonds because they expect interest rates are going to go down. This is all part of the interest rate betting game that you really shouldn't be playing, but I'm trying to explain it so you know what everybody's talking about when they talk about these inverted yield curves. And yeah, often when the yield curve inverts, it precedes a recession. But folks, recessions happen. They just do. We expand economies, we contract economies, we've lived through recessions, and we've lived through expansions. We like the expansions, we hate the recessions, but recessions tend not to last very long, and we're going to have another one someday. So what? I mean, really, so what? It happens. But there's this game being played with interest rates, and that's exactly what it is. It is a game. Now, the media is also playing a game with interest rates. By traditional measures, an inverted yield curve occurs when 30-year treasuries are yielding less than 2 to 5-year treasuries. By that definition, we do not have an inverted yield curve. But people like to play fast and loose with the numbers, and because 1 month through 1 year treasuries are yielding in the 2.4% range right now as of the 28th of March when I'm recording this, and 5-year treasuries are yielding 2.18, they're calling that an inverted yield curve, and by traditional definitions, that really isn't. Traditional, I like, and again, everybody has their own, but traditionally, it's intermediate term bonds to longer term bonds. And right now, the 1-year treasury is earning 2.4 and the 30-year treasury is earning 2.83%. The 2 years at 2.2, the 3 years at 2.16, etc. The 10-year is at 2.39. Comparing the 2 to the 10, no inverted yield curve. Comparing the 1 to the 30, no inverted yield curve. Comparing the 5 to the 30, no inverted yield curve. Not that it matters, but it really isn't inverted. And at least it's positive in the United States. We have positive interest rates. Those of you who live off interest, can you imagine what a state you'd be in if you lived in Germany or Japan? As of today, the 10-year government bond rate in Germany is negative 0.01%. In Japan, it's negative 0.1%. In other words, investors are actually paying the governments of Japan and Germany to keep their money safe. That's a real inverted yield curve. And yet they've had negative rates for many years, and we really haven't seen a recession in Germany. We've seen a soft economy in Japan, but we've seen that for a long time, and that's due to some demographic issues more than almost anything else. But we can't be sitting around wringing our hands over the short-term news, and I think that's the basic message. Stop worrying about it. If it does invert at some point, then maybe we'll have a recession, and we will at some point have a recession, and maybe it'll be a bad one, or maybe it'll be one that we forget we had like most of the rest throughout history. The only ones we really remember were the big ones, the 30s, the stagflation of the 70s, and the big 2008 one. But other than that, we've forgotten most of them, so quit worrying about it and give me a call with your questions about money at 855-935-TALK, 855-935-8255. You can call 24 hours a day, 7 days a week. Gosh, it's so easy. So give me a holler. And let's go to a call because we've got several of them now.
Hi, Don. Robert here. My question is in regards to our Roth accounts. Both accounts have 4 American funds, Class A mutual funds, purchased in the late 90s. One account has about $220,000, the other account $270,000. Would we get a better investment return if we cash these funds in and purchase index funds? We were thinking of Vanguard's Total Stock Market and Total World, both Admiral shares. Our risk score is about 70. And we don't need the money at this time. We're in our 60s and retired. And if yes to purchasing the index funds, what percentage would you place in each fund? And also, are there any additional funds that you might recommend that we consider? Let's see. We've got Growth Fund of America, Investment Company of America, and New Perspective, New Economy in those. I appreciate the show, and I appreciate your time. Take care.
Well, I have to give your broker a little bit of credit. At least your broker, when he or she puts you into mutual funds, puts you into what is probably, maybe arguably, but no, I think, in my opinion, it's the best of the loaded mutual fund groups, of the active mutual fund groups, loaded and active. It's a combination. It is not an index group. The American Funds Group runs their funds. They run a pretty tight ship. Their fees are not ridiculous. They're not great, but they're not ridiculous. Their performance has been good. And it shouldn't be, your determinant should not be, will I make more by going to index funds? Because you may or you may not, because so much of what happens with actively managed funds can be attributed to luck. So can they be luckier over an extended period of time than the index? Yeah. What you want to do is flip the odds in your favor, and there are ways you can do that. There are a couple of things you can do. One, reducing fees should increase your return, right? If you have two funds with the identical portfolios, the one with the lower fee is going to have a better return. And the fund that I would suggest you get for your equity position, you only need one, would be the Vanguard Total World Index, Stock Index, which is VTWAX. That's the Admiral shares. They have an expense ratio of 0.1% per year. Let's compare that to your 4 American funds. Growth Fund of America, 0.62% per year. Investment Company of America, 0.57% per year. New Perspective Fund, 0.75% per year. And New Economy Fund, 0.77%. When you look at all of those stocks, all of those funds, you're going to own less than 1,000 stocks approximately, because there's overlap between the portfolios. When you own Vanguard Total World Index, stock index, you own just under 8,000 stocks as of today, globally diversified. So you get the same kind of global diversification. You actually get slightly better global diversification in terms of being in various types of markets. You get it at a tiny fraction of the cost. You get far better diversification, which the science tells us should reduce your level of volatility. And generally, when looking at the standard deviations of all these funds compared, the Vanguard is giving you slightly lower standard deviation, and it's going to be even lower because at your risk tolerance level, you probably should be looking at no more than 70% of your portfolio in stocks, the other 30% in bonds. And again, the trick is to look at your portfolio as one entity. So when it goes down, you're not saying, oh, the stocks went down, but the bonds didn't. You went, no, the stocks went down. Or you say, no, the portfolio only went down a little, because you want this to be an entire portfolio. Don't think of it as individual funds. But I would look, just to keep it simple. That's the other thing. Keeping it simple is good for you. At Vanguard, I would look at the VTWAX, and then the other one is the Vanguard Total Bond Index. And the Admiral Shares version of that is VBTLX. And get this, its expenses are 0.05%. 0.05%. Barely existent. The other thing is you're looking at indexing versus active management, which we believe active management, we believe, will not, should not, over the long term, beat indexing. Not when you account for fees. So I think long term, you're likely to be better off. You're certainly going to have a simpler portfolio to manage. You're definitely going to have lower expense ratios. And you are absolutely going to own a whole lot of securities, a lot more than you would own owning any active fund that I'm aware of. I mean, when you throw the bonds in, you're probably looking at 15 or 20,000 different issues, 8,000 stocks and 10,000 bonds or something. So well diversified for sure. And please remember, you can call your questions in any time to 855-935-TALK, 855-935-8255. And if you need some help with money, go to TalkingRealMoney.com. We've got all kinds of stuff there, information, and it's going to get even better because I've been working, prior to recording this, I was working all day on a new version of Talking Real Money to make it even easier to find the things you need. So check it out. If you need some more advanced help, more advanced than the help we can provide calling the show, because that's generally pretty quick questions. We do also offer free time with our 100% fiduciary, no sales pressure advisors ever. Just set up an appointment online right there at TalkingRealMoney.com, TalkingRealMoney.com. Thanks for listening. Please spread the word. Tell a friend or two. Subscribe on your favorite podcast service, particularly Apple Podcasts. And listen again tomorrow as I'll be doing another Talking Real Money Daily podcast. Take care. I'm Don McDonald.
Talking Real Money.
Need a little help with your money? Free advice awaits with a fiduciary fee-only advisor with no cost or obligation.
Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.